There we go. Hey, everybody. I'm Maggie Lake, and I am talking market today with Jeremy Schwartz, CIO of WisdomTree. Hi, Jeremy.
Maggie, so great to be with you. Thanks for having me on. Congrats on your new show.
Thank you so much. And the new show is on the road 1 month in. I am in Ohio. So, hello, Buckeye Nation, if we have any of them in the audience. But it's great to catch up with you on this Friday because, wow, we're in a new regime. We had stocks off to the races. They did take a little bit of a breather today. But talk to me about this Fed decision. It seemed to catch some people by surprise.
Well, we're closing the week basically at all-time highs for a closing week, 5,700 on the S&P as we're getting into the close here. We would say we were very happy with the Fed decision. We've been on my mentor and our senior economist at WisdomTree, Jeremy Siegel. He would run the Fed so differently than they're run. And, he's been saying that they need to do much bigger cuts, much faster, that their status quo bias, we call their MO, is going very slow, 25 basis point deliberate type cuts, when he would be at neutral today. Like, don't delay, get to neutral, because our view is that the unemployment rate is at their long-term target. They say their long-term target is 4.2%. They're right there. Inflation, you could argue, at least is 80%, maybe even higher to their target. Our view of inflation is that's lower than the reported statistics. So we would say they're at target, but if you use the official data, it's sort of close to target. So like, why be 250 basis points restrictive versus neutral, and why take so long to get there? So, you thought they might just go 25. Most of the economists did think they were going to go 25, but they did go 50. So it's a good start. And that was a positive, and the market sort of bounced around, first up and then down, but then huge move the next day. And you could say, well, there's less of a chance of a recession, which is why sort of the 10-year, even though they went for a bigger cut, was higher. The 10-year yield went higher.
Yeah.
On a view, the recession was less of a chance, which, it shows it's a positive response towards what they did.
I'm so glad you brought that up, because a lot of people were saying, wait a second. So stocks off to the races, but look at treasuries, the treasury yields actually, they are ending the week higher. And so what is that telling you? So it's interesting. You think that that's telling you that, okay, we've avoided a recession and we aren't going to, is the knock on that we're not, does the treasury market think that we're not going to see more aggressive rate cuts?
Well, actually, well, I don't know that you could say we've avoided the recession, but there's less of a chance today than there was 2 days ago, and so we're not 100% out of the woods. At 370, it's still a pretty pessimistic take on where the 10-year yield is. I mean, our view longer term is the 10-year should be in the 4 to 5% range. And you get that from a 3.5 to 4% neutral Fed fund. You say, like, what is the neutral rate? And this comes to some debate of where should the neutral rate settle. The neutral rate, the Fed in their dot plot, they've been ticking it higher, went from 2.5 to 2.9. And we think they're going to keep ticking higher to 3.5. They keep moving it. Again, they're slow and deliberate pace. They don't just move it in one shot. And again, this is just their dot plot that they release every quarter, but it's been ticking higher. And we think that there's going to be an upgrade in the assessment of the economy. And so neutral will be like 3.5. And what you have today with the Fed funds, it had been 5 3/8, and now it's down. But, the inverted yield curve, almost 150 basis points inverted between Fed funds and the 10-year before today, before the cut. That's not normal. It should be a positive slope. You should get 50 to 100 basis points of positive slope in a normal balanced economy. So that's why you're talking 4 to 5. And this is not factoring in any concerns about debt and deficits and all these issues with borrowing and where's the debt go over time? Is it manageable? So this is just a normal functioning economy. You get 4 to 5. So you can still say the 10-year is kind of pessimistic of where it should be in the long run, at least where we think it should be in the long run. Now, but it's being less restrictive says, hey, there's less of a chance of the Fed making a mistake. They're bringing it down. maybe they bring it down more. Some people said, oh, this now means we got an inflationary coming back because these.
Yes, that's what I want to ask you about, because that's and it's worth pointing out for people who haven't been following. I think WisdomTree and Jeremy have been a bit of a contrarian call on this. Professor Siegel, you've all been talking about the Fed needs to do more, and everyone's like, hang on a second. We have the economy doing well. There's still money sloshing around. People don't think inflation's tamed. They look at the exact reasons you just laid out, all this debt, both sides of the aisle, a U.S. election coming, and it looks like the government's going to keep spending like crazy. Why would you lower interest rates in that kind of environment? They're not too restrictive. But it sounds like you agree with some of those things. So explain that. Yeah. Explain the difference to me.
Well, let me focus on two of those points, and then we could drill into anything I didn't cover. First on is the money sloshing around. Because that's one of the things. Siegel has been a huge, huge proponent of looking at the money supply as a measure of inflationary pressures. And this is one of his big critiques at the Fed. He's like wondering, where is anyone at the Fed for talking about the money supply? Anytime people ask about this, they say there's no relationship between the money supply and inflation. Well, he went to Chicago right after he graduated MIT. He was trained to be a monetary economist, by the way. A lot of people think he was a finance person. He was trained to be Jerome Powell. That was his PhD. But he went to the University of Chicago to study Milton Friedman. Inflation is everywhere, monetary phenomena, and said, hey, when there's a huge explosion in money, inflation is going to come 18 months later. What the Fed started doing wrong is looking at this minutia of month-to-month changes and said, hey, there's no relationship. But when you have an explosion of 40% growth in the money supply, inflation is going to come 18 months later. What happened? Inflation came right after the explosion in money. Now, what's been happening recently? It has not been exploding. It actually was concerning last year, was contracting. There's a number you want to remember for what the money supply should grow. The number you want it to grow is around 5%. 5% means 2 to 3% growth in the economy, 2 to 3% inflation. That gets you 5% money supply. We're not growing at 5% today. We're growing well below 5% today. So that tells you in some ways the Fed is too restrictive because it's not growing at that balance that would give you 2 to 3% real growth in the economy, 2 to 3% inflation. It's growing much less. Yeah. So money supply, one, it's not quite sloshing around. The second, on the actual level of inflation, and you saw this in the latest CPI, we've been, if you follow me on our Twitter feed, I put out something every inflation report that's our own version of the CPI that recalculates it with one simple substitution. Pretty simple substitution. Everybody talks about, core is X energy, X food, sort of these volatile food prices, energy prices. Then they try to do sort of super core. They take out real estate. The real estate is a kind of a crazy statistic, which is it uses this BLS shelter, which is a very slow moving, series. And 80% of shelter is a survey where they call you and ask you, what can you rent your house for? Which is kind of a crazy way to get a survey of like, what is shelter inflation in the US? And that says today, that number officially is over 5% for the last 12 months. Now you say, is that the real world? If you go to things like Apartment List, which is a measure nationwide rental costs, it's negative on the year. Now, that's saying that's the perfect number. There's all sorts of ways of getting rental costs. Zillow has a measure that's like 3%. So if you average the Apartment List in Zillow, you're at like 1.3. And if you were to plug in those two, that simple substitution of the average of Apartment Lists in Zillow instead of the BLS, I get headline inflation of 1.2 and core inflation of 1.6, which is literally half the reported statistics. Half. 1.2, 1.6, well below 2, and well within the Fed's goal. So, but that partly is a statement that over time, and Powell is, they started recognizing that over time. We think they were slow to recognize that early on when they were calling inflation transitory. There wasn't quite an appreciation of that series and the dynamic in that series, but they more and more became confident that it would come down, and that's going to be a tailwind to inflation cooling. Now, people worry that if they lower rates too soon, you'll get all these other inflationary pressures bubbling up. You don't see it in the sensitive stuff at the moment. The sensitive commodity prices have been trending down. We think shelter is a tailwind. Yes, there could be flare-ups, supply chain issues. Could there be some kind of war that breaks out in a more serious fashion that supply chains get even further hung up? Yes, inflation can come back, but the trend is positive. And hey, would it be the worst thing that they lower rates to avoid a recession than they raise rates? The Fed is too concerned about keeping the short-term rates stable. They're doing the exact opposite of what they should be doing. They should be letting the short rate move around, and then the long rate would be more stable. What they're doing now is the long rate is super volatile, and the short rate is stable. So Siegel would flip it all on their head. He would let the short rates move around as needed and let the long rate be more stable.
Yeah, and that volatility in the longer end of the curve has been so painful for people. And it also matters a lot, right? Because we talk about the 60-40 portfolio and people looking for bonds as something that's safer and less volatile, that they can hedge maybe some stuff in their portfolio. So it's blown the whole thing up the last couple of years. I just want to acknowledge we've got, hello, everybody in the chat. It's great to see you all on a Friday. I'm happy that you're happy to see each other. We have some good questions and a couple of them about a curve, but I just want to mention something, Jeremy, because some people are, again, saying, listen, they were so aggressive, and when they go big like that, it's usually before something really bad happens. I think some people were referring to 01 and 07, and there have been a lot of those calendar correlations this year. I think Bo mentioned that in the chat. Is it a sign of alarm? Is there something the Fed knows that we don't know? Is there something they're overly concerned about? Or is this a sort of new proactive Fed that we have to get used to? Powell used that word recalibrating that, grabbed all the headlines. But how are you thinking about it? And why should we not see this as a sign of panic, I guess?
I mean, the rude take is saying, like, what has the Fed shown that they know about the economy? That's being like rude and cynical. It's like, have they actually shown they have any special insight this whole entire cycle? All right, that's really, being a jerk. But it's actually very productive that they cut, and they definitely are data focused. You say they're focused on on the data dependence, but the question is, what is the framework they're going to use to monitor things? And again, coming back to the employment is at target, inflation is close to target. Why should they be 250 basis point restrictive? It's just recognizing the reality that they, where they are, that they are now too tight. It's not some sense of, the economy's crashing, but it's saying we have more risk of being too high for too long, and we should be proactive. In reality, they should be at neutral today. And then the question is, what is neutral? And the neutral is probably higher than they're saying, but there's no reason to be so restricted. And so, if the only reason to not do it is because of the status quo bias of, hey, we can't shock the market. That's the only reason to not do it. It's not having a special insight. It's not things are falling apart. It's just that, they're basically at their long-term targets, and they're definitely risk from being overly restrictive. And I think what you saw, and that there was all this question about the messaging. Do they know something we don't know? And that we thought was all misguided. We thought the market would respond very even if they did a more aggressive emergency cut that Siegel was calling for. If they went for the big cut, is that showing a sign of panic? No, it would be the market. We thought the market would view it positively. It wasn't about the market response. It was about doing the right thing for the economy. And he was trying to shake up the conventional narrative of just being so slow, but it wasn't.
That's a really interesting way to put it, because it is one of the things that people look at. I want to ask you about this environment that we're in, though, because it is so. If that is all true with the Fed, and listen, in their statement they always talk about balance of risks, right? That's always something they're focused on. So that makes a lot of sense what you're saying. Based on that they now feel like they were not in a neutral place where the risks were balanced, and they had to move more in that direction. But they're in an environment now where they've got a fiscal impulse that's much different and potentially more inflationary than it ever was before. Back in the day, it was really, they could operate monetary policy and they weren't really getting this big spending. We've come off this huge spending and we're facing an election. We know what happens in election years. Does that present an issue for the Fed?
Well, it's an input to the economy, and you say, why we shouldn't be surprised we haven't had a recession with all the deficit spending that we have. I think there is a question of what do you do about the deficits? You're hearing fears about the debt and deficits more and more. There's no party that's really trying to address it. Nobody, you're not hearing.
Definitely not.
We're not trying to bring the deficits down. It's the question is what to do about it as an investor. I mean, there's a lot of talk, and then the question is what to do. Now, the bond market is not concerned at all. I mentioned the 370 on the 10-year. That's not reflecting a concern about the debt. And actually, what we say is, when do you know they're going to get serious? Is if you actually had a spike in that 10-year. If the 10-year went from 370 today, and all of a sudden, you got a new policy and it spiked 100 basis points overnight, that would tell you they're going to have to start taking it seriously. And that basically what happened in the UK not so long ago. They had Liz Truss as prime minister. She came in, she was going to lower taxes, and basically
the market let her know exactly how they felt about that.
And she was out in 2 weeks, and they had a new policy. The government doesn't take this stuff seriously until there's a real crisis moment. And you don't want to say, like, when will our Liz Truss moment be? That it's a matter of when and not if. But
yes, let's not even conjure that, shall we?
But it may not be for 10 years. It may not. We put out some charts in our presentations that shows our historical debt to GDP. You got to remember the U.S., our debt is not just a U.S. phenomenon. Our debt's held globally. So why just look at U.S. GDP? The people who are buying our debt are all around the world. So now you got to look at, the amount of U.S. debt held in the U.S. versus U.S. GDP. That ratio is much, much lower than the official numbers because it is getting global. So you can either look at U.S. debt versus global GDP, U.S. debt versus only the domestically held debt versus U.S. GDP. Then you could think about how much is our wealth, how much is our capacity to pay versus the debt levels. And that's even more sanguine. And then, you could get till the real problems with the deficit is probably 10 years out. Our spending on all the, the Social Security, Medicare type programs, it takes 10 years for that to really, it basically flatlines. Debt to GDP flatlines for the next 10 years, and then it hockey sticks, basically 2030, in the mid 2030s. But that when you do it, like the domestically held debt versus wealth, it may not be 30 years before you get back to even where we were in World War II. So we've managed through this stuff before, but it's going to take a crisis to get the politicians serious.
Yeah, we have a lot of comments about the dollar weakening, and we know there's a whole narrative around that we could dig into. Before we touch on that, I want to ask you globally how you're viewing things too. But we've got to talk about U.S. stocks for a moment because it's really important to unpack what just happened, because we had a Fed that cut rates for the first time in 4 years, and they cut big. So really important to get your views on that. But we saw the reaction in stocks. Are we likely to continue to see that? Where do you think the action is now? Is it all risk assets? How do you see this playing out?
Well, there's definitely fears with market at all-time highs. Are we overextended, overvalued? Where are we? The multiple on the S&P is 21 times earnings. We often will say for 21 times forward earnings. Obviously, those earnings have to be delivered. They got to deliver on that to get the 21 times. But that, you have to use some estimate of what you think the forward potential is. And that corresponds to a 5% earnings yield, which we use as a sense of real return. So you do 1 divided by 21, a little bit under 5%. You would add inflation on top of that, 2 to 3%, to get your nominal. What will the S&P do? So you're talking 7 to 8% returns over a long period. We're talking like the next 5-7 years is the type of outlook that we use with that earnings yield plus inflation model. When you look at bond market, we said 3.7 on the 10-year. So the real yield is 5 on stocks. The real yield is 1.5 to 1.6 on bonds. So it's still a 300 plus basis point equity premium. Another way of doing it that I often like to say is you take 1.6%. There's a rule of 72. How many years will it take you to double your purchasing power in real terms
Hmm.
And you do 72% divided by the growth rate. So 72 divided by 1.6, it's over 40 years, over 40 years to double your purchasing power. In stocks, it's 14 years. It's much more reasonable. So are stocks still a good bargain, versus bonds? Yes, for sure. They're still a good bargain. Now, can you get cheaper stocks? Yeah, you could buy small caps, with profits at 12 to 13 times. And so there's definitely good bargains out there. Foreign stocks are much cheaper than the US. And you say, well, they don't have the tech leadership that we have. So they're cheap for a reason. But if their earnings don't collapse, you buy a 12%, 12 PE is an 8% earnings yield. That's a pretty good return without growth. No, you just need the earnings to be constant. You don't need growth. You just need the earnings not to go to, to fall down. So we do think there's other places to be, but we think stocks are reasonably priced where they are.
I love that math. I love that equation because I think that really speaks to what people are thinking about, because we often talk about all the time, time frame matters, right? So if you're really young and you're starting out, everyone's trying to build wealth. And so not a lot of people have 40 years to try to do that. They need it sooner than that. So when we're looking at what is your feeling? So we're talking about US stocks generally. The tech stocks, there was so much concern about that AI bubble bursting. And yet we saw some big moves. I mean, Apple, big move. Again, it seems like once the Fed waves that flag, we just have everyone pouring back into that sector again. Do you see a rotation in the ETF world? Are there other things that look interesting? Are we going to see more diversification this time around?
We do think that small caps are a beneficiary. I think they're the ones paying the highest rates from the Fed.
Everyone's been waiting for that though, and it hasn't happened, right?
But it's because the Fed hasn't been lowering rates is part of the answer. I mean, there's two answers. One is that the actual earnings growth has been way better for tech versus everybody else. So it goes back to are they cheap for a reason? Well, they're cheap because their earnings have been terrible. We have a dashboard. We do a lot of daily dashboards, and throughout earnings season, we have a daily dashboard for earnings season. And for this last quarter, large cap S&P type earnings were up double digits, 11% plus year over year. Small caps were down 15%.
Ouch.
So why are they down? Why are they not so good? Their earnings have been terrible. Now, the outlook is getting better. So next year, the Magnificent Seven is accelerating, and the 493 is accelerating. So they're moving higher. Small caps are not supposed to be down; they're supposed to be growing. The lower pressure from rates, they definitely have seen
are more rate sensitive, right? Their
interest costs have gone up. So that directly will feed into lower borrowing costs for the people who are the most extended. But it has to translate, for small caps to really do better, the earnings environment needs to change, and the expectation for earnings need to change. And so it's starting to get a little bit better. We've said you need to see the rates actually come down for them to turn. And it seems like we're now starting to get that. And now they have to deliver that second part where the, earnings environment goes. But the recession, a lower chance of a recession is good for small caps. So I do think all of that stuff from the Fed is very helpful.
Yeah. And it's going to be an interesting space to watch, because I feel like, but this is part of the fits and starts we've had before. And is it a recession? Is this a soft landing? Is it no landing? And I feel like not only did treasuries get whipped around, but some of the hopes and dreams for small caps did as well in that. I want to shift gears slightly and ask you about something that I saw, and that is you guys I know that you've been doing things around blockchain and really had your eye on that and some of the financial innovation that's happening. And it's something that we're always curious about, especially when we're talking about new products. So did you just launch something? Did I see that? What is WisdomTree doing with that?
Yeah, well, thanks for that. There's a few different developments that people should be knowing about. Like one, about a year ago, we launched a direct-to-consumer app called WisdomTree Prime. So everybody, not everybody in the U.S. has access, but most of the U.S. has access. We keep adding more states. There's a few states like Texas that still don't have access, but WisdomTree Prime is a wallet where we have 13 different assets in there, from gold to Bitcoin, Ether, different equity baskets. but critically a money market fund that you could tie a debit card to. So I have moved this to be my primary banking relationship. I fired my old bank who wasn't paying any interest on the deposits. Basically people have too much cash earning nothing. And so now you should really never have cash. You could have a direct debit card. I have the Visa debit card in my Apple wallet where I could pay with my card, and it basically is coming directly from a money market fund. And the idea is with all these assets, whether it's gold or Bitcoin or your whatever on the bond market you want, you could spend off of that. So you could put your own denomination of your checking account in gold effectively if you wanted to. So there are all these kind of cool features that we're doing in WisdomTree Prime. The debit card and money market fund is there today. Some of these other spending features are coming. Those are things we're working on. But what we announced this week is an institutional portal where we're making that money market fund available around outside of the wallet that we have, that WisdomTree Prime wallet with our direct to consumer. That same money market fund is now for people on the blockchain who institutional use cases called WisdomTree Connect. And for people who might have USDC, sort of one of these stable coins that you don't earn interest. So I was critiquing the banks. I fired my largest banking relationship. All my cash is in WisdomTree Prime, effectively. I still have some bills that come from these other banks. So maybe there's a small percent not in my bank. But WisdomTree Prime is now my home for all my spending stuff. Well, there's a lot of people in the crypto world who have USDC, 110 billion in stable coins. There's one of the famous stable coins where the group launching that stable coin takes all the interest. They don't pay it out to people. It's sort of just like a bank. You talk about this novel technology, the blockchain. Where's my interest? The company's keeping it, not you, the owner of the stable coin. Well, this money market fund for people in that blockchain world can be used, and we accept USDC as part of that. And so there's a lot of novel stuff happening where you could transfer in USDC, you get the money market fund, you get right now it's 5%. Obviously rates coming down, you're gonna get a little bit less, but you'll get the interest that you would owning a traditional money market fund. And I think there's a lot more we can do. There's a lot of cool things in the WisdomTree Connect where you get an NFT to identify. It's a pretty cool identification.
Let me ask you a question. Yeah, let me ask you a question. So obviously, and I just want to caveat that I didn't know everything that was going on, and you have to do your own homework and assess your own risk. And there's always risk with everything. So I just encourage you to do that. This is not an endorsement of you plowing into this or any of this from either Jeremy or I. But why do you expect wider adoption? Because obviously this is sort of a business decision, because I feel like, we know that there's a big debate. Some people won't touch crypto, some will. Yeah. But do you feel like, it sounds like you're saying, and this is so interesting to me, that just financial services are moving in this direction. I mean, obviously you guys are early to it, but should we all expect to be getting offered stuff like this and need to understand what this means? This sounds like a pivot for all of us.
It should be. I think people have, what we're talking about is, when I talked about, I've made WisdomTree Prime my largest banking relationship. It's not a bank. WisdomTree Prime is not a bank by any stretch of the imagination. We are just a wallet with these different tokens that you can spend from. I mean, we have the functions of spending from a fund, which is like it's sort of taking that technology forward. And usually you give your money to the bank, they take the money, you're now a depositor at the bank, and you got the deposit risk. And so people would go and try to diversify how many banks they had their money, if they had, the deposit limits. But the bigger issue was that they could be getting the 5% on their money market funds, but, it's not broadly available. I mean, I was talking to an advisor. I was out at Future Proof this week. I was talking to an advisor who's a large advisor at one of the major custodians. And it was strange that like half his clients didn't have access to the top yielding money market fund, which is very strange. Basically because that custodian is trying to not let the clients earn the appropriate rate in deposits. So it's, I think there's a lot of use cases. This is how banks make their money. It's sort of how that stablecoin, the $110 billion stablecoin takes your cash and invest in the treasuries for their own balance sheet. That's what a bank does. You give the bank your cash. They don't pay you the appropriate interest rate. They go and invest it and earn some kind of spread from lending, buying treasuries, whatever they're doing. That's how they make their money. This is changing the banking model. You know, you should now earn the appropriate interest rate. It's pressure for the banks.
I was just going to say that. So the flip side of this, aside from, I think it being really interesting to hear about these developments and sort of begin to understand what they are and what they mean. And obviously we need to do a lot more digging. I mean, you know it because you're launching it, but for the rest of us. But the flip side of that is this is potentially super disruptive for banks. And as we approach bank earnings, I mean, financial is a huge area. This sounds like, do we expect them to just dive in as well? Or you're not, this is not just the product. This is a way that this is fundamental change in the business. It sounds like you're saying.
Well, it's always hard when there's disruption, right? It's like when the mutual funds, when you had an ETF, they could have launched the ETF. And all of a sudden, 30 years later, some of the old mutual fund companies have finally starting to launch ETFs. It's hard to, when the business model starts to change, do you see it? And it's going to be tough because the banks are used to not paying the interest. Their funding is from people giving the checking accounts and not caring that you could earn 5% in money market fund. Now, people say money market funds, $6 trillion at all-time highs, but there's trillions and trillions and more getting zero when you could be getting 5.
Yeah. And or as somebody pointed out, maybe by November it'll be 4, but still it's not
4,
0.
Right. 4 is still pretty good. It's still pretty good. So I think it's worth checking out as a direct-to-consumer WisdomTree Prime to get that 4%. And you could spend off of it, but you could also spend off of gold if you didn't, if you wanted, you didn't want to sell something to buy gold. You could eventually have a gold token that you could make your own gold standard where you could sort of pay in gold. I think that's
it's and we know there are a lot of folks who love gold in this audience. Really fascinating stuff. I'm definitely going to have to we're going to have to dig into it more, and I'm going to go check it out. But really appreciate you kind of filling us in on the forward stuff that WisdomTree is looking at. I know that there's a whole world of this going on, so important to kind of thread through it. But really fascinating stuff. Well, Jeremy, we just about got to wrap up, but what's top of mind for you? I mentioned we are moving into earnings. We know we're going to be getting a lot more data. We're going to get more Fed meetings before the end of the year. We've got a U.S. election coming up. What's kind of top of mind for you as you look across markets?
Well, I think the Fed was a risk for the markets. They took off some of that risk this week. And, I think that's very positive. When I look around the world, there's been a lot of volatility this summer. Japan is probably still my top idea. Internationally, it's one of the cheapest markets. You got Buffett, who's been buying a lot of those Japanese stocks. He's selling his Bank of America. He's selling his Apple. He hasn't been talking about what he's been doing on his Japanese holdings. We'll see what goes on there. And I think he's approaching the limit. He wanted to not really past 10%. He was approaching 10%, but I think those are cheap value stocks versus some of the other things he owns. So I think that's still one of my top ideas. I've been cautious on China because of all the dynamics. It's starting to look, this week it started to look a little bit better, but the long-term outlook has been very tough. So I like Japan, like India, as my top 2 international ideas. And that thinking about the rates benefiting small caps is probably, one of the rotation themes we're looking for. So there's still, I think, more upside there as you go into next year.
Fantastic stuff. Jeremy, always enlightening to catch up with you. I love it. And you've given me a lot of things to think about and go do some research on. I think we can all agree about that. So thank you so much.
Maggie. Enjoy your weekend at Ohio State.
Thanks. Go Buckeyes. And somebody's joking around about it looking like I am headed out to dinner, which is so funny because I don't know how you know that, but I am going to go we are going to go see my daughter and catch up with her roommate and her parents. And I am so excited because I miss her terribly. I'm sure all of you who are listening, who have been through this know, but it's super excited. So I'm so happy about that. And thanks to everybody in the chat. You guys are the best. Some really great ideas shared in there. As always, I see Christopher and Paul going back and forth, and Bo and Ralph, of course. So thanks to all of you. And I cannot believe we made it on air remotely. I'm really happy about that. So thanks, everybody. Have a fantastic weekend. And as always, take care and good luck out there.